Trading is broken into two parts. And in today's video, we're going to talk about what these two primary things are. Let's jump right into it. So the two parts that trading is broken down into is psychology, which is 80%, and technical analysis, which is 20%. And today, we're going to focus on that 20%, which is the technical analysis. Technical analysis has two primary focuses, right? There's market structure, and there's candlestick analysis. A lot of traders in my day and age, they like to turn to indicators such as moving averages, which is very popular in this field. But the problem with indicators such as the moving averages is that they're delayed. They are based on a certain component that allows you to predict the trend, but is not accurate until after the fact. But what does exist in the market is market structure and candlestick analysis, which in my opinion is the best. But market structure is what's happening in real time. The algorithm in the markets is always changing, therefore indicators would have to be updated. If you see indicators like the moving average, the ADX, the MACD, and so much more, just get rid of it. Completely get rid of it. When I first started trading, I was using the moving average and I was using the ADX, and I just had to honestly get rid of it. I would always miss the move or get into the move kind of late. I would never have a precise time where it says to buy or to sell. And all those indicators are trying to do was read market structure and understand candlestick analysis. Now, in my opinion, the goal in trading is to be independent and not dependent. And you can only be independent if you're doing it yourself and not relying on fancy indicators. Now, let's jump into market structure. Market structure refers to the arrangement and organization of the market participants, including buyers and sellers, and their interactions, which provides insights of the overall trend and the direction of the market. Whether it's stocks, forex, commodities, cryptocurrencies, or even real estate, studying market structure can help identify patterns and trends and actually guide investment decisions based on understanding the dynamics of the markets mixed with supply and demand. But the main primary thing is that investors can gain a better understanding and potential price movements made with informed trading based on market structure. There is three types of market structure. There's a bullish market where the market structure is ranging upwards. There's a bearish market where market structure is trending downwards. And there's a consolidation market where the market is ranging sideways. Now, the reason why I mainly focus on market structure is because it's a foundational technical. With market structure, you're using the components of how aggressive buyers and aggressive sellers are handling certain market conditions based off of the trend, versus indicators are based off of data which already printed, which is delayed. Which leads me to my next thing, candlestick analysis. Candlestick analysis stems from candlestick charts. Candlestick charts are a visual representation of price moving in patterns in the financial markets. They were developed into Japan by the name of Hamo, forgive me, I think I'm slaughtering it completely. In the 1700s, he noticed that the market prices were slowly driven by supply and demand, but also driven by the emotion in traders. Candlestick analysis and candlestick charts use different colors and shapes to represent price movements, making it easier for traders to interpret the analyzed market data, basically of the trend. Traders can often look for specific candlestick patterns that occur regularly, such as, the bullish engulfing, the bearish engulfing, and they also prove insight for potential long-term and short-term directional movements in the market. By understanding these patterns, traders can make more informed trading decisions, which I feel like in my benefit is why we need to use candlestick analysis. So let's jump into the next thing, how to read a bullish candle. So basically, to sum it up, when you're reading a bullish candle, from the bottom of the body, keywords, the bottom of the body is where price opens and price closes at the top of the body. The wick above the open signifies the highest point that buyers went to, but also symbolizes buyers' exhaustion. The wick below the open signifies buyers' rejection and also the lowest point that the market went to. So that's pretty much how you read a bullish candle. How to read a bearish candle. To read a bearish candle, it's basically the opposite of a bullish candle. Where price opens is now on the top, and where price closes is now on the bottom. So the wick above the open with this bearish candle is going to signify sellers rejection. They're rejecting away. And the wick at the bottom signifies sellers exhaustion. So when you combine both market structure and candlestick analysis, you get an understanding on where price is going, and where to enter markets based on what it's currently doing. You need to keep your process simplistic in trading because simplicity is gold. By using indicators, you can complicate your understanding of what price is trying to do because they're delayed. With indicators, cause a bunch of issues. Versus using market structure and candlestick analysis, you'll be more sharp, more aware on what the current market conditions are trying to show you and where price is going, where the market is trying to make you understand structure levels with candlestick analysis and market structure. So if you want to understand market structure and candlestick analysis on a deeper level, join my free Telegram chat. I drop a video once a week where I basically explain market structure and candlestick analysis on a deeper level. There's things like the overall trend that you need to kind of understand based on market structure. There's things like the move making a retest and you projecting that whole movement based on candlestick analysis and market structure. There's things like understanding price at certain levels, and there's other things like seeing where markets leave, where buyers and sellers kind of completely leave away from the market. So you want to ensure and make sure that you're studying this on a deeper level. Candlestick analysis can help you read levels of what price is planning to do based on major reversals, or show you when buyers or sellers is leaving the market. Keep in mind, the goal is to be independent, not dependent. And you want to make sure that you treat your process based on market structure and candlestick analysis because you're in control of what's going on. Versus an indicator, it's delayed and it's going to give you delayed data based on what already happened. Make sure you get your dependency in order. You get that dependency that you need from market structure to build a solid foundation. With that being said, I hope you're able to gain a lot of value from this video. Please comment below what your 2 primary things that you use in trading are, and let me know if there's any magical indicator that's some holy grail that helps you read market structure and candlestick analysis accordingly. This is your boy Drewizebanks, and I'll see you guys on the next one. Deuces.